Good afternoon and welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the MarketSite in Times Square, we have Dillian. He's a strategist over at Mauldin Economics, as well as a contributor for Bloomberg and Forbes, and one of my favorite traders to follow on Twitter. It's so great to have you back with me in New York City. All right, the FIRE strategy, it often misfires. Tell us about the FIRE strategy.
So FIRE stands for Financial Independence, Retire Early. And basically it's the idea that you can save a huge amount of money, 75% of your paycheck, for the first 10 or 15 years of your career, and then retire at age 35. And then you retire with about $1 million, and then you can live off the $1 million for the rest of your life and never have to work again. That's what FIRE is.
Okay, I'm having a hard time wrapping my head around this because $1 million in today's money is going to be very different when you're 35 and then very different as you live throughout your retirement. This sounds risky to me.
Well, it's not perceived as risky because we've had a bull market for the last 10 years, and people who have done this for a little while have had good results, but they have not yet experienced a bear market. And what happens is when you get a bear market, if you're not working, then you're staring at your brokerage account every day and watching it go down and thinking this is your life savings and it's disappearing, and it's a little tough. Basically, the rule of thumb is that you can withdraw 4% a year when you retire. And if you still have investment gains over the course of your retirement, then you should be fine. But there's path dependency. It depends on when you retire and when bear markets hit. So not to mention disasters such as illnesses and broken down cars and whatever.
Is the FIRE strategy a relatively new concept?
Well, the new concept is retiring at age 35 or 40.
Right.
That's the part that's new. I mean, the good thing about FIRE is that it has people thinking about and doing the math on the, what am I trying to say?
Thinking about savings.
Thinking about savings and investing over the long term and what they can retire with. Nobody's really thought about this before, but it's being perverted and people are retiring way before they really should.
Right, well, and you also have a gap in your resume. That's got to impact you as well, right? So let's say you've been out of the workforce 5, 10 years, skill sets have changed. I mean, look how different our economy, skills that are required right now is very different even than 10 years ago.
Yeah, I mean, that's the problem. If you retire at age 35 and then for some reason you have to go back to work at age 45 and you've been out of the workforce for 10 years, you're kind of host. But the thing is, the thing that I have the most problems with about FIRE is that you live in deprivation for 10 years, saving, so that you can live in deprivation for the next 50 years.
Right.
And you don't get to enjoy yourself. And the thing about the FIRE people is that they really dislike consumption as a philosophy. They don't think that consumption makes you happy. And the reality is that making money and buying nice things and taking vacations and buying big houses makes people happy.
Yeah, make me happy. I don't know. I just don't think I could live out that philosophy, and to each their own, right? I would just imagine you're done working at 35. I'd get bored.
Yeah, the thing that the FIRE folks say is that they're able to pursue their hobbies and interests. And in some cases, that really is a hobby, like photography or writing or something like that. In some cases, that's taking a job that might pay less than another. So they retire from a high-paying job and they take a low-paying job. Maybe they want to be a teacher, which is, I can sort of see that.
Or freelancing.
But for the hobby standpoint, like if I took up writing as a hobby and I wasn't getting published and doing this as a job in 5 or 10 years, then I would be bad at writing. So, a hobby, if you do it long enough, becomes a job.
Right.
And you start getting paid for it.
Is there a better alternative to FIRE, or is it one of those things where it's not all or nothing, everything in moderation?
It's saving is terrific. Saving is good. But I think the main takeaway is that consumption is not bad, and that people should be able to enjoy themselves. So instead of retiring at age 4, I mean, retire at age 55, retire at age 65. I want to work for the rest of my life. My job is what I love.
Exactly.
I love what I do. I write financial newsletters. I can see myself doing that in my 80s.
Yes.
Because it makes me happy. I don't understand why people are so unhappy at their jobs that they feel they want to leave them after a very short period of time. An unstructured free time that people have is very dangerous.
Yeah.
It makes people very unhappy. So,
well, all right, we have you here and we have some time. When we met, I believe, over the summer, the market feels very different now than it did back then. What's going on in your head in terms of everything? Global macro feels very different than it did over the summer.
yeah, I mean, there's sort of an inevitability about this bear market that we might be having. And I say might because we're not there yet. But like I said, there's this inevitability. People feel like it's going to happen. You're seeing the delta in things like jobless claims has turned and is heading higher. Economic statistics are just beginning to break down. So you're starting to see a little bit of weakness, and that's being reflected in markets. And, I think the Fed is seeing it. Jerome Powell just softened his view on interest rate hikes. Just this morning, the Bank of Canada softened their view on interest rate hikes. So yeah, I mean, I think we're clearly entering a period of weakness, and it's just a matter of how deep this is going to go.
Right. So do you stay invested at this point? Do you think people are going to the sidelines with cash right now, or is it just markets don't go up like they have over the past 10 years? That's not normal. There are machinations and cycles and so forth, where remaining invested. It's kind of how it works.
I don't remember what I said when I was here before, but the one thing I've been preaching constantly over the last year or so is that cash as an asset class was becoming more attractive. That you could go on treasurydirect.gov and buy T-bills for 2.5%, and 2.5% is pretty good. Short-term corporate bond funds were getting you 3 or 4%. Those were starting to look like pretty good alternatives to being fully invested in the stock market. If we have a bear market, short-term bonds and cash is pretty much going to be the only place that you can hide out. So,
I mean, if we go into a bear market, do you think it'll be prolonged or feel like 2007, 2008? That had a very specific event to trigger it.
The only thing I can say is that valuation matters. And when you look at periods of time where valuations got extreme to the upside, then forward returns going out many, many years were very low. So the valuation extreme that we just got up to the upside sort of matches off with a couple in history. And forward returns for the next 10 years are about 0%, like historically. So, we might not have, I can safely say we won't have a financial crisis. We won't have something as severe as what we happened in 2008.
Right, you were on Lehman. Weren't you on Lehman's desk?
Yes, I worked at
that time.
Brothers, yeah.
So that must have, I'm sure you have a very good look in terms of visibility, what this look and feels like.
It's going to be. I mean, it's every recession is different. It's always different, but it probably won't be as severe. But yeah, I mean, the stock market got ahead of itself, and you're looking at, diminished returns going forward.
Let me ask you something else. When you were at Lehman, and you have a great read, I love reading your content, you have a beautiful mind. Did it feel like something wasn't right going into it, even exclusive of Lehman, that housing prices were becoming inflated? There were other things going on in the market that just didn't seem right.
Yeah, I was part of a group of people at the firm that noticed what was going on with the housing market as early as 2005 and 2006, that it was excessive. In terms of problems at the firm, people had varying degrees of awareness of that. I was sort of aware of it. 3 or 4 months before the bankruptcy, I did look around for other jobs because if you looked at the stock price, the stock was relentlessly going lower every single day. The messages we were getting from management was different from the messages we were getting from our peers at other banks. People said that Lehman was in trouble, so it's a very complicated question.
Right.
Yeah.
All right. Well, interesting, great insight as always. Thank you for joining me.
Thanks.
And thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.